Now, let's practice the variable overhead spending and the efficiency variance, for example, the supplies. In the same way as we practice in the variance analysis of the direct labor and direct material variances, we also use this concept of price variance and the volume variance, but it's the same concept, but we change the name of these variances, the spending variance and the efficiency variances. Okay, the flexible budget variances is comprised of the spending variance and efficiency variances. And then we can calculate these spending variances, actual rate per the cost driver unit minus the standard rate per cost driver unit times actual quantity of the cost driver used. Also, the efficiency, we use cost driver. Why? Because these overhead costs, such as these supplies, cannot be easily traceable, so we use some specific correlated cost driver, for example, labor hours, to calculate this actual rate for the overhead spending and the quantity of actual quantity and standard quantity of this variable cost. Okay, so let's go to the practice. Here we go. We have the variances, flexible variances in the supplies. The overhead cost, the variable overhead cost, $500 unfavorable. And then we want to identify what causes to this 500 unfavorable. Is that from the price, the spending issue, or the volume issues? So we want to identify. Also, the factory supervision in the fixed cost overhead. We want to know where this unfavorable result come from. Okay. So we are using the actual and the standard data of direct material and direct labor, but once we determine that the cost driver is direct labor hours for variable overhead, we are not using this direct material cost. We will focus on this direct labor cost. So let's go. The actual rate. What is the actual rate per direct labor hours related to this variable overhead cost? Now we are using this 3,750 for the direct labor hours. So we want to know the actual rate per 1 hour, per one direct labor hour. So how do you get it? Right, here you go. The actual cost of the overhead, 4,700 divided by 3,750. So $1.25 is the variable overhead cost per 1 hour for the supplies. Then, what is this actual quantity direct labor hours? Okay, we are using again this direct labor cost. So again, the reason why we are using this direct labor cost and direct labor hours is that as a cost driver is that we cannot trace the supplies spending and the volume in a usage, every usage of this the direct the variable overhead. Okay, and then standard rate. How do you calculate this standard rate? In the same way, we have the flexible budget, the supplies overhead divided by the standard. There you go. Standard, the quantity of output level achieved, 3,500. So we got the standard rate per direct labor hours is $1.2 per 1 hour, and standard quantity direct labor hours allotted for output achieved is exactly the same as 3,500 hours. Okay. Oh, sorry. It should be dollar. Okay. Then the flexible budget overhead spending efficiency variances. Actually, we haven't analyzed the actual and the standard data, the fixed overhead at this point, because as we discussed in class, the fixed overhead, the variances calculation is relatively easy because there is no the overhead, the fixed overhead, the efficiency variances, because variances never incur in efficiency, the volume, because the fixed overhead, for example, the salary does not vary or with the level of use of the cost driver, because there's still the same number of supervisors can be used in production. So we do not count this overhead efficiency any longer. Okay, then actual overhead cost. How much is the actual overhead cost? Now let's just multiple actual rate and actual quantity. So 47, and then the actual quantity. Oh, let's go this one first. Flexible budget, the standard standard quantity direct labor hours times standard rate per direct labor hours. So 1.2 times 3,500, so 42. Now let's calculate actual quantity direct labor hours used times the standard rate per direct labor hours. So where do we get it? There you go, 3,750 actual quantity times 1.2, so that we can identify this overhead spending between actual overhead cost incurred and the actual quantity direct labor hours used times the standard rate. Is that favorable or unfavorable? Okay, overhead cost in actual is greater than this flexible, the budget part, so it is unfavorable. Now let's get this by just copy and paste, so it automatically calculate the absolute distance. So it's also the flexible budget with the standard quantity and standard rate is lower than the actual quantity and standard rate, so it is unfavorable. Then, as we practiced in class, if we have two the variances which have the same the unfavorable, then we can just combine these two, because the flexible budget overhead variance is the sum of this overhead spending variance and overhead efficiency variances. So we can just sum up that unfavorable result. How about the fixed overhead cost? Factory supervision in the actual overhead cost. Where do you get it? Okay, there you go. 14,700 was the actual cost in factory supervision. And the total cost also here 14,400. The reason why it doesn't change, again, for the overhead efficiency. Okay, number of the supervisors doesn't vary with the level of use of the cost driver. If we use the overhead cost, then it is not correlated with the increase or decrease in the number of the supervisors. Okay, so let's calculate one more time. I just want to copy and paste. And then you see here we have unfavorable result because the actual is greater than the budget, and then it's just nothing. And then just the sum of these two, we got 300 unfavorable result. Under this unfavorable result, we recognize that the variable overhead cost $500 that was coming from the overhead spending unfavorable, and also the overhead efficiency unfavorable. So the managers managing this variable overhead cost related supplies should take a responsibility of reducing this overspending and the overusage. Okay? See you in the next video clip. Bye-bye.